Welcome back to the Retire Young radio show. I am your host, Joshua David, having a great time in studio on a mission to improve financial literacy worldwide. If you're just tuning in, Al was shedding some light on how the financial markets work, and it's based off of supply and demand. And most people base their decisions off of news, fundamental news, which creates an opinion. So you have to have a strategy and a plan and follow that plan to make better decisions in your accounts. Now, as we get into this next segment, Al, we have, when we talk about the smart money, we were talking about the institutions, the banks, the brokers, the ones that are always creating income in the financial markets. Now, the public, they don't understand that we have those same techniques. We can use those same strategies that they use, but the public just, the average person just hasn't learned those. Now, let's talk about those different techniques and those different strategies, which may also include other asset classes. First off, let's talk about why the stock market is so great for the institutions when they're creating income, but what are some of those techniques that we can use in the stock market as well?
Yeah, the stock market is by far the best asset category to be in for long-term wealth, for building what you're going to rely on during your hopefully your golden retirement years. And the way that Wall Street does that is not the way that they have you do it. And you mentioned that we can do things that Wall Street does, and the reason that people don't is that they're not educated on those things, and they're not taught them by Wall Street. It's ironic to me that what Wall Street tells their clients to do is not what they are doing.
Imagine that, huh? Yeah, it's one of those do as I say, not as I do.
Yeah, and what is the primary go-to with Wall Street? It's just buying and holding. It's putting together a portfolio, and then don't worry about the losses, the profits that are there. Just hold on for decades and see what happens. That's not what they're doing. And one of the reasons that they do so much better than the novices, than the public, that smart money does better, is because they manage those portfolios. You can have a long-term stock portfolio, and you can do things, you can use assets along with it to kind of boost the returns, to generate premiums off of
and
what
that's
you
not
have.
Guaranteed either.
Nothing is guaranteed in this market. The only thing that's guaranteed is that if you're working with an advisor, there will be fees that you have to pay.
Correct.
But nothing is guaranteed. The point is to have as many probabilities or odds in your favor, to have an edge that you can follow that gives you consistency. And it will be different for different people. People have different goals. They have different personalities, different expectations from the market or from whatever they're looking at to kind of.
Well, basically everybody's in a different place in their life. So that's why.
Sure, right. Exactly. And that's why there's not a one-size-fits-all kind of strategy or investment that is out there. But that's unfortunately kind of what happens. It's that buy and hold. Here's some choices. Here's some investments that you can choose from, and then just hold on to them for decades. That's not what Wall Street is doing. They're concentrating on profits. They're taking profits when they see a good profit, and they are very much so aware of loss and managing that, so they never have a big loss. They know how to control that. They know how to control the risk part of trading. And those are things that everybody has access to. Those are things that we concentrate on in education. That's what proper education should do. It should not be something that just concentrates on one thing, but gives you some choices, because there are different market conditions, and there are different, again, expectations that people have, different reasons for looking at the financial markets. We were talking in that first segment about the buy right and sit tight. Well, one of the things I mentioned was selling too soon. And the reason people do that is that it's hard to identify what a proper target profit potential should be. Let's just say that somebody buys shares of Apple stock. It starts going up in value. How do you decide when to sell if you want to protect a profit? Well, when anything goes up in value, it's because there are more buyers than sellers. So it just seems to make sense that if it stops going up and starts going down, it's because sellers took over. And that's the key, is to be able to identify where those sellers are on a price chart, and then conversely, where the buyers are on a price chart too. Those are the two key components in deciding when to get into something, when to get out of something, and when to do it, when to get out of a position with the more realistic profit target.
I'm really glad you kind of explained it that way, because, think about this. Most people buy and hold with no plan of gain or loss. And that's why it's so important to have a plan, rules within that plan, because when you're talking about when the institutions are taking profits, they don't just guess. They have set targets, right?
Correct.
And when they get there, they get out of their positions, and the public just doesn't understand that. Well, you have to get educated and learn how the smart money is doing that. So with the stock market, you have basically you don't really have a whole lot of buying power. The capital requirements to trade 4 times per week is a certain amount of money. Now, there's buying power with other leveraged asset classes, futures, you have Forex, and you also have options. And with those, you have that leverage. Like, for instance, Forex, you have 50 to 1 leverage. Futures, 20 to 1 based on which contract you're doing. And I want you to explain those coming up here shortly. But so, Al, I mentioned the futures market and the Forex market. Those have buying power. Now, there's other reasons why the smart money is using these, probably, I would guess, probably more than the stock market,
right?
These fixed asset classes. What are some of the other reasons that they use them, and what are some of the perks that come along with these other assets?
Well, one of the reasons they use them is that futures and Forex trade basically 24 hours a day. So with the stock market, there's limited time within which somebody can trade and have access to the components of that market. 6.5 hours that the stock market is open. 24 hours gives you the opportunity to trade at your leisure when you choose when you want to do it. You know, maybe you're tied up during the day. Maybe you're tied up during the stock market hours, and it's hard for you to participate then. That 24-hour trading gives you a lot more.
Well, it's essentially, basically, these other markets, like these other countries, they're opening up. So that gives the opportunity for us here to do the same thing that they're doing there. It's just online.
Exactly. And the other thing is that all of these leveraged assets have high liquidity. In other words, you're never going to have a hard time getting into or out of a position. And the higher the liquidity, the smaller the spread. And by that, I mean the difference between what you pay for something and what you can sell it for. With some stocks, that spread is quite large, which means the stock has to move a fair amount before you even can break even.
Yeah, basically, you don't get the price that you're asking for.
Right. But the real benefit there is that it maximizes the purchasing power of your money. Basically, it allows you to control contracts that are much more valuable than the initial investment. That's the leverage part of it. And that's why the institutions and why the pros use those. The futures, the Forex, they can also be used as hedging techniques. In other words, protecting what you have. With futures and Forex, you can buy contracts, you can sell contracts. You don't have to do what normally people would do in a down market, is to short something, which means you have to borrow something you don't own, sell it, and then buy it back at a later time and return it because you borrowed it. Hopefully then you buy it back at a lower price than you sold it for. That's shorting. But that means you have to be able to borrow a stock. The stock has to be available from the broker. There's a margin cost there. But with the futures and the Forex, those markets you can buy and sell and experience the same benefit as you would have gotten from shorting. And also with these markets, there's good diversification. We talk about diversification a lot. That's what Wall Street is telling you will provide protection for you in a portfolio. But what they do is they'll put you into maybe 5, 10, 15, 20 different stocks or different mutual funds and tell you that that's good diversification.
So, Al, let's discuss what those futures are, though. What is a futures contract? Because everybody understands the stock market. People want that tangible feeling of owning a stock. Well, what's the difference? Or is it the same?
Well, if you want to trade stock, if that's the asset you want to look at, you can trade stocks within the futures market. What futures really is looking at what something is going to be worth in the future. You do a contract on that. You can trade the major stock markets. So if you want to trade stocks, you can trade the Dow, you can trade the NASDAQ, you can trade the S&P 500, the Russell, some foreign markets, and do it with a futures contract, again, with that leverage that the futures market provides. You can trade commodities, sugar, soybeans. You always mention lean
hogs, yeah.
Orange juice, gold, silver, oil, currencies, interest rates, a number of different things there. Really some good diversification, true diversification, because with a typical Wall Street diversified portfolio, you're still all in the stock market. And when the market is correcting or crashing, the correlation becomes so great that pretty much everything gets sucked down, sort of like pulling a plug on a bathtub. That's not the case in the futures market. There's some great true diversification assets that you can use. The foreign exchange market, that's where you're looking at the exchange rate between two different currencies. You trade that as a pair. That's 50-to-1 leverage. That is phenomenal. Again, it's open 24 hours a day, and you get leverage there also. There's a number of things that these provide that just investing in stocks or mutual funds won't provide for you, and that's why the institutions use them. And the other asset that they use are options. Options, futures, and forex can be used for shorter-term trading. Options can be used for more midterm and long-term, as can forex. But options can also be used to boost the returns of a stock portfolio. Options can be used to actually mimic a stock position, so you don't actually even have to own the stock.
When you mean boost, I mean that you're just talking about, that just means the buying power will let you purchase the stock more so at a discount. So the brokers, I guess we'll say, will allow you to do that.
Yeah, right. You get leverage there with options. You also get a benefit with the return portion of it too. If you look at the underlying, because options are always traded on something like a stock or an exchange traded fund, that underlying, if it's up 10%, this is kind of a rule of thumb, the option will be up maybe 100%. So
and that's a fact in the strategy, right?
That's exactly right. Yeah, and then when I was talking about boosting the returns, what I'm talking about is collecting premium from an existing portfolio.
Okay.
Options can be used that way. One way to do that is what we call a covered call. And we talk about these things. These are the things that our students are taught in these classes that you'll be talking about.
Yeah, and just to be clear, that options and futures and forex, that's not going to boost everybody's returns. It just has more opportunity because you have the buying power. I just want to make that clear so everybody understands that. When you explain these different assets in these investing classes, some people think it's just so complicated because it's just different. It's not new. It's just different. And when we were talking about in the first segment, price action on a chart is how you're placing your decisions. So a lot of people think you have to know everything about every single currency or a commodity, whatever that may be. Remember, you want to use charts, which is essentially telling you what's happening with price, and those are facts. Those can't be fabricated. So, Al, I want to give away a couple tickets here for an investing class. And in these investing classes, you really talk about the common mistakes that some of the novice will use, but also different ways that you could potentially eliminate them, or at least lower or minimize your mistakes, because it's all about making proper decisions in your accounts. Al, I want to continue this discussion about, you mentioned options, and a lot of listeners want to understand, well, how can I use options in retirement accounts? A lot of people think your only options, no pun intended, are mutual funds. Mm-hmm. So let's talk about that. What are some of the different quote unquote options in retirement accounts? But I also want to get into self-directing. This is Josh and Al. We will be right back.